Bloomberg Audio Studios. Podcasts, radio, news.
Joining us now is Adena Friedman, Chair and CEO of NASDAQ. And of course, there is a lot of excitement, investor excitement for the IPO market to be coming back, the largest IPO of the year, of course, listing on NASDAQ. What does the pipeline look like? Can you say the second half of the year has more room to run, especially when you have the election ahead?
Well, first of all, thank you so much for having me. It's great to be on your set. And we are really, really proud of the overall results that we've delivered for the quarter with 10% overall growth. We've had 29% growth in our index business and 16% growth in our financial technology business, which of course has been an area of real strategic focus for us. As we look at the IPO landscape and the markets part of our business, we've seen slow progression, I would say, in the IPO market. We're coming off of a very tough year in 2023, so we're seeing slow progression. Very excited about Lineage this morning, joining the NASDAQ family of companies. We had OneStream yesterday. So you're starting to see the investor appetite increase for taking risk with the IPOs. But I would have to say that we still think that it'll be slow progression as we continue through the year. The monetary policy outlook and other geopolitical factors, I think, are still keeping investors a little bit more risk they have a little bit more risk aversion. But we're seeing some real good progress, and we think that going into 2025, we should see more momentum in terms of the pipeline of companies that we've been talking to.
When you think about the competition ahead in this market as well, do you think that NASDAQ has an ability to gain even more share? What does it look like behind the scenes? Are you out there courting every 2025 potential right now?
We meet with companies years before they go public. So we really focus on the complete life cycle of a company. When they're early stage companies, we work with them in terms of helping them in the private markets manage their liquidity with NASDAQ Private Market. We work with them on their governance practices and making sure they're maturing their governance. We start to introduce them to investors through our IR services before they go public. And then, of course, they go public, and then they become public companies. And that's where we have a whole cadre of capabilities that help them become great public companies. But we're talking to companies well before their IPO plans so that as they think about the public markets, they think about NASDAQ. We had a 72% win rate in the quarter. We're continuing to show that NASDAQ is the venue of choice.
We saw a global IT outage a couple of days ago, reminded the world how fragile things are. NASDAQ was fine, actually, and you offer a suite of IT services to exchanges to guard against those things and financial crimes that I didn't even really know about, showing huge growth. Talk to us about the new businesses that you've diversified into.
Sure, yeah. So with the CrowdStrike challenge, our markets were not affected. The technology we provide to other markets and to the entire financial community were not affected. But of course, you can always learn lessons from those types of situations. And we are partners with our clients. We talk to them and work with them around resilience and redundancy and all of the things that they can effectuate to help manage those types of challenges or at least prevent those types of challenges, as I say. Now, our fintech division is where we sell technology to other exchanges. We have risk management technology, anti-financial crime, regulatory reporting, all the core challenges that banks and brokers face in managing their lives across the capital markets and banking. And that actually grew 16%, as we mentioned in the quarter. We're seeing a huge amount of demand from our clients. We had 67 new clients sign up for our technology. We had almost 100 upsells and 4 cross-sells, which actually is really starting to show the power of the NASDAQ platform across those vectors of risk.
As we look forward to an election in November and prepare for a slate of maybe new regulations or fewer regulations, how do you think about the outcome of the November election for your clients?
Yeah, we kind of look at the fact that NASDAQ, of course, as a market, we're successful in any administration. I think that NASDAQ as a company, we really focus on managing through political cycles. And we've been here for 52 years. We expect to be here for another 252 years. But I think that when it comes to overall, what are the corporate environment? What do corporates really look for? I think they look for consistency, predictability, and an administration that really fosters growth and innovation, because that really fosters economic growth. And so regardless of who's ultimately in office, can they create consistency? Can they create some predictability in the regulatory environment? And can they put in policies and practices that really drive innovation and growth? I think that's what companies in general look for.
I want to go back to what Matt was asking about, these other businesses that are not IPOs, the financial technology businesses. When you think about artificial intelligence, generative AI, where are you seeing the biggest payoff? Because you look across corporate America and people are investing. So where are the dollars at the end of the road?
Well, first, I would say it's super important to get the right infrastructure in place and the right architecture of your solution. So NASDAQ has been investing in moving all of our technology solutions into a cloud environment now for over 10 years. And that is really paying off, because by doing that, you're modernizing your data infrastructure, you're modernizing your architecture, and you're making it so that you can bring new technologies in faster, and you can play, I'd say, offense much more quickly. So a couple of things that we've been looking at, that we've been doing. First is in our markets, we launched something called the Midpoint Extended Life Order, which is an AI-driven order type, the first one that's SEC approved. We've seen a 20% improvement in fill rates and a 20% improvement in our volumes in that order type since we launched that in April. So that's an algorithmic AI capability. And then Gen AI is a new technology that's really come onto the scene very quickly. If you already have all of your infrastructure and data in a cloud environment, it allows you, therefore, then to take those capabilities in. So in Verafin, cloud-based anti-financial crime tool, we launched an entity research co-pilot that automates the process of researching entities that have generated an alert in the system. Takes down the time to do that research by 90%. So it's really a great way to automate more of those workflows. And we have a new one that's come out in our investment tool for asset managers to summarize the pension board meetings, which gives them really quick insights into the strategies of the pensions, allows them with their business development to engage better.
As a CEO, how do you think about future investment in AI, Gen AI? Is most of that investment going toward new technology or retraining your workforce?
Well, we say it's on the business and in the product. So we're quickly launching these capabilities in the product and then teaching our clients how to use them and automate and make it so that they can be more efficient. But then we're also introducing new tools. So we've introduced the co-pilot tools for our development organization. We should be fully rolled out across all our developers by the end of Q3. But then you have to educate. And so we've been managing our education throughout the year, making sure they understand how to use them, what is it good for, where do we see the most benefit. And we've had hackathons. We've had over 650 employees participating in some hackathons we ran this quarter, so that you're starting to really get them to understand what's the power of this technology, how can we drive productivity, how can we drive efficiency, but then how do we also create new capabilities in the products. And to us, that's a big part of our future.
I want to ask separately from NASDAQ. You're on the board of the New York Federal Reserve. And we got some pretty stunning GDP numbers in today, 2.8%. We got higher quarterly PCE than had been expected, 2.9%. We got lower jobless claims than had been expected. What's your view on the economy here, and do we need rate cuts?
Yeah, I mean, at the highest level, the economy continues to be quite resilient. Now, we are seeing that inflation is coming down, and so it's coming down and normalizing. You're seeing GDP growth slowing, but still robust, which is fantastic. But you are seeing the higher cost of capital start to impact larger parts of the population. And citizens are really starting to be impacted by that cost of capital. So that's all of, that's an interesting calculus for the Fed to have to manage through. And then with rates at what I would say restricted levels at 5.5%, you do have a pretty big delta between GDP growth and the cost of capital. So there is an opportunity there for the Fed to start to think about how do they moderate that and get that more in line, now that even though PCE maybe came up a little bit higher, it's really still coming down quite precipitously from last year.
Do rates and IPOs, is there an inverse relationship there? I would imagine if rates are high, then the cost of capital from private credit lenders is higher, and you might prefer an IPO, and the opposite must be true.
Well, actually, I would look at it a little differently. So when investors evaluate a company for an IPO, they look at what is the potential future earnings of that business, and they do what we call discounted cash flow analysis. And if the cost of capital is higher, they're going to discount the future cash flows more. And so it actually has an interesting inverse reaction where the higher the cost of capital, the lower value they put on future earnings. And that has therefore, I think, had the effect that we've seen on IPOs. Why has the IPO environment been so difficult? It's because the cost of capital has gone up precipitously. Investors have a hard time modeling future cash flows. Now we're starting to think that perhaps the cost of capital could moderate. That makes it easier for them to predict future cash flows. And we actually think that could be a catalyst for more IPOs going forward.
It's a whole market working on that valuation reset. Adena, we thank you so very much for your time. Of course, that is Adena Friedman, Chair and CEO of NASDAQ.